Hello and welcome to the 248 Emerging Companies Funds report for the March quarter 2026. We've often noted that March quarter tends to be the most volatile for our markets, and 2026 has unfortunately lived up to that reputation. In the third quarter of 2025, if that was defined by the scrambling of supply chains due to US tariffs, this year has presented an even more complex set of challenges. March saw what many are now calling SaaS apocalypse and the associated fear of what this means for software companies, particularly with the heavy private credit exposure to some in that sector. All this occurring simultaneously with a massive energy price shock triggered by the escalating conflict in Iran. So look, for us, SaaS apocalypse represents a fundamental repricing of the software sector. The combination of AI-driven efficiency, which has drastically reduced the cost of software development, and a corporate-wide move away from the seat-based licensing structure has hit valuations meaningfully. Rule of 40 calculations are being squeezed as investors question the high growth rates, low discount rates, and strong profit margins of a sector once known for its high-quality investable characteristics. Compounding this tech reckoning is the geopolitical situation in the Middle East, reigniting inflation fears just as we thought we were entering a period of rate stability. We're yet to see direct impacts in portfolio company financials up to 31 March, but we're looking out for it. Portfolio companies are again being forced to look closely at their logistics and their cost exposure. So what does all this mean for our portfolio companies? Look, in our view, there are very few, if any, companies that don't have both an opportunity and a threat associated with AI. It's different for each company and it's different in each industry. Each of the portfolio companies is working very hard to figure out how AI should be used and integrated into workflows across every part of the organization. It's also worth noting that across both funds, we've got very limited exposure to pure play SaaS, and the companies themselves have very little debt. But each company is taking the opportunity and the threat very seriously, as are we. In other news, against the odds, we finally saw some movement in the microcap IPO market, with Barrenjoey getting home delivery mattress company Koala to IPO in the quarter. It was positive to see the company and the brokers hold their nerve in another tricky first quarter backdrop. At the moment, what's happening in the IPO market is still just another strong pipeline, but the successful Koala IPO and subsequent trading strength is a positive signal for liquidity in private markets.
In fund-specific news, during the quarter, unit holders and their advisors received communications regarding the fund term for both Funds 1 and 2. Fund 1 will reach the official end of its fund term on 1 May 2026, while Fund 2 will see the fund term extended by 1 year from 1 May 2026. The Fund 1 wind-up is a process rather than a single event, and the timing of realisations and distributions will depend on when assets can be realised. Both the trustee and we as the manager consider it in the best interests of all unit holders to realise assets in a very orderly manner and at appropriate values. Our focus remains on realising the remaining assets of the fund in an orderly fashion, and we'll keep unit holders and advisors informed of this process via ongoing periodic status reports. To date, just as a recap, 6 investments have been realised in full, with circa 75% of committed capital returned to unit holders, and 8 investments remain. For Fund 2, we've notified unit holders of the extension of the fund term by a period of 1 year from 1 May 2026. Given there are still 10 unrealised assets held by the fund, we believe it's in the best interests of unit holders to extend the fund term by 1 year to enable a further period of time and realising the fund's investments in an orderly manner. We encourage unit holders to contact us with any queries or concerns they may have regarding the fund term. We're more than happy to talk to you or respond to emails at any stage.
Okay, so we'll just jump into the portfolio. We've included details about the portfolio companies in the quarterly reports, as we usually do. We won't go through all of them on this call, but just to touch on a few, starting with Fund 1. Bellroy continues to deliver strong top-line performance with high double-digit growth for the year to date. The new carry-on luggage products, which were launched in 2025, have been very successful, delivering well over initial forecasts. This month, the company will launch a new range of check-in luggage. Check the website, you might be able to see it. And we expect similar success, with luggage becoming a major category and a major growth lever for the company. Bellroy paid a dividend during the quarter and retains a very strong balance sheet. Deep Blue Company, which is the parent company for the conveyancing.com business, is back into double-digit top-line growth and is now delivering maintainable profitability on a monthly basis as they continue to focus on service delivery efficiencies. The company continues to explore partnership-led lead generation opportunities. We like the opportunity for DBC to gain market share, and the company is considering an inorganic growth strategy as well. Moneytech has strong momentum as a business with a record loan book and strong earnings momentum in the March quarter. The company has now undertaken a share buyback and paid 2 dividends in the last 12 months. The company is mindful of bad debts, and this is a real key focus for the board and management at the moment with the backdrop of what's happening in the economy. And the payments business Manuva continues to trade very strongly with double-digit revenue growth year on year and profitability well above budget. With its category high revenue, strong balance sheet and cash generation, Manuva really is the clear leader in the Australian market for real-time payment service providers. And lastly, Studiosity has completed the acquisition of Norvalid and is working on trialing its enhanced authorship validation product among Studiosity's strong university customer base. The majority of Studiosity's customers have now transitioned to the AI module, and the company continues to win logos.
For Fund 2, the key highlights were Automotive Superstore continuing to grow revenues at 30 to 40%, in contrast with a tough consumer backdrop. Business is expected also to sign a new, larger lease that will provide significant runway for future growth. Boost Media has grown its pipeline and secured a number of key contracts, should see it deliver meaningful revenue and earnings growth. However, the company does have some exposure to the events in the Middle East, and this is something we're monitoring quite closely. Cloudworks is performing well and is focusing on shifting its revenue mix from one-off discrete projects to recurring managed services revenue. Working capital and cash collection improvement has also been a highlight for us, allowing the business to reinvest the excess funds back into the company and support future growth. Future Group has delivered strong performance year to date with high double-digit revenue growth and high margins. We've been very impressed with the company's ability to integrate acquisitions, drive administrative efficiencies, whilst also maintaining strong organic growth. We've already spoken to Deep Blue, Moneytech and Manuva, which are part of Fund 2 as well, but sit in Fund 1 alongside. Moving across to performance. The fund performance is contained in the quarterlies, and you can see a summary on the screen now. For Fund 1, the original committed capital was $1.80 per unit, and of the original $45 million raised, distributions to date total almost $33 million, or $1.31 per unit, and the remaining net asset value of the fund at 31 March was $33 million, or $1.32 per unit. Combining the total amount distributed to the net asset value, we come to a total of $2.64 per unit. The 3-month performance of the fund, net of fees, was approximately negative 4.8%. And since inception, net of fees, the fund has returned approximately 46.4%. The since inception net of fees IRR of the fund as at 31 March is approximately 10.7%, with 8 remaining positions left in Fund 1. 1 is listed and 7 are unlisted, and we believe there is upside in the carrying values. Each company is actively in a process or engaged in discussions regarding a sale or a liquidity process, and will provide investors with an update on liquidity over the next few weeks. Now looking at Fund 2. Fund 2 original committed capital was $1.80 per unit, and of the original $85 million that was raised, distributions to date total $16.5 million, or 35 cents per unit, with the remaining net asset value of the fund at 31 March being $83.9 million, or $1.78 per unit. Combining the total amount distributed to the net asset value, we come to a total of $2.13 per unit, and the 3-month performance of the fund net of fees was 2.86%. Since inception net of fees, the fund has returned approximately 18.6%, and net of fees IRR as at 31 December is 4.23%, with 10 investments remaining in the Fund 2 portfolio. Again, we believe there's strong upside in the holding values as the companies continue to grow and improve.
That's the end of the video today. Thank you very much for joining us, and thanks for your continued support. As always, you can reach Jono and I on phone or via email to discuss anything from the reports.